Hey everyone, Josh Martinez here, and welcome to this week's idea. So this week's idea is looking for buying opportunities on the S&P 500 on a daily time frame. Let's go ahead and get into it. So a couple of things to notate. Number one, indexes tend to go up over time. So because this is the S&P 500, you are looking at the very best of the best, the top 500 stocks of the United States publicly traded stock market. That's what the S&P 500 represents, also known as like the market. So people will say, I want to beat the market, right? They're talking about the S&P 500. So it tends to go up over time just because of the way it's designed. When there is a low price, especially on a daily time frame, if we can get it right, we can normally get 7 to 11 candlesticks of follow through. Now, because this is a daily time frame, each candlestick represents 1 day of market movement. So 7 to 11 candlesticks is realistically 7 to 11 days of follow through. So let me give you an example. So if you take a look at these previous lows, and it's not perfect, but from this low, 1, 2, 3, 4, 5 candlesticks up, and then some left to right movement. From this low, 1, 2, 3, 4, 5, 6, 7 candlesticks up, and then retracement. This low, 1, 2, 3, 4, 5, 6, 7 candlesticks up, then a retracement. From this low, 1, 2, 3, 4, 5, 6, 7 candlesticks up, then a retracement. From this low, 1, 2, 3, 4, 5, 6, 7 candlesticks up, and then a retracement. So if you think about it, if we can get this right, there's about a 7 candlestick rally opportunity or 7 days of bullish movement. Granted, we also would like a catalyst, something good inside the market that would really create the follow through, because it could even be more. So how do we do this? Well, what I like to do is I like to start with my trend lines, and I draw my trend lines going backwards on the most recent low. And the reason why I do this is because I'm a big believer that the market likes a U-turn at, on, and around the same price points. And if for whatever reason we can begin to see by just simply doing this technique, we've discovered an angle that's been U-turning the market. Now, normally, whatever the angle that pushes the market is also the angle that pushes the market down. So this blue angle pushes the market up, just copy it, bring it up top, and that's usually the angle that pushes it down, and you can see we have that as well. And so all this really means is if this market were to move from this bottom blue level to the top blue level, which has done several times already, we are looking for a target of somewhere around 6966.25, which would be right around 1,102 ticks, give or take, depending on where you measure. So what's the plan here? Well, you know, as long as the market stays above that bottom blue level, the plan is look to buy it towards the top blue level. But I don't like to physically enter in off the daily time frame. What I like to do is take this information and go to a smaller time frame. And when I go to the smaller time frame, such as a 1 hour time frame, all I want to do is look for the market entering into the buy zone, and then I'll apply my favorite entry strategies on the way up. So right now on the 1 hour time frame, the market is still in the sell zone. Now this is where people get confused. They go, well, how is that possible? How is the 1 hour time frame in a bear trend and the daily time frame is sideways saying bullish? What does this mean? Well, once you kind of understand that, it will make life a little bit simpler, in my opinion. So the top chart is your daily time frame. That means every candlestick represents 1 day of market movement. The bottom chart is your hourly time frame, so every candlestick represents 1 hour of market movement. So if you think about it, if the CME is a 23-hour a day market, then realistically, there's 23 times the candlesticks on the smaller time frame than there is on the larger time frame. So naturally, we're gonna have more waves. So as the market moves from the top blue level to the bottom blue level, there's going to be a bear trend that forms on the smaller time frame. Now, when or if the market moves from the bottom blue level to the top blue level on the daily, well, then this bearish trend should end. In theory, then a bull trend should begin, right? And so for me, what I like to do when I draw my trend lines, I'll divide the market into a buy zone, sell zone. I will use the larger time frame for guidance and just say, hey, it's not a good time to sell the market because usually the daily time frame bounces bullish at this price point. So instead of selling the market and probably losing, I'm just going to wait to see, can the market enter into the buy zone? give me a low price in the buy zone, and then I'll apply my favorite entry strategies, and I'll do this for the next 1,000 plus ticks on the way up. Now for me, I'll be using Fibonacci to guide me. That would be a really, really fantastic thing. And it looks like we're very, very close. Now you may say, well, what if the market does sell off, right? What do you do then? Well, for me, I just stay out of the market. And the reason why is I don't like selling things that go up over time. This is an index, and an index does go up over time. The S&P 500 has a historical average of right around 10% increase annually. Now, not every single year is a bullish year. 2022 is a bearish year, right? But if you have something that continuously grows, and we're not at an all-time high yet, it's probably going to grow if it just does what the normal average is, right? And so if that's the case, then I'll just wait it out. If the market sells off, great. I'll just wait for the low to be done and then start to strategically buy it back up. I'm okay with that, and so far that has worked really well for me, and hopefully it can work well for you. All right, so what we ended up doing is if you go to tradingview.com and you search up my name, Joshua Martinez, all one word, no spaces, no numbers, no nothing. What you can do is you can go to my profile, and what we do is we post ideas. Now, nothing's perfect, right? Last week's idea, we were monitoring long light crude oil, and we're expecting the market to continue to increase, but the market did not, and the market never gave us our entry. So this was last week. We wanted that counter trend line to be broken, but the market, what did the market do? The market, instead, never gave us the entry, just broke bearish, right? Took out the Fibonacci, but then the market still increased, right? Which is great. However, you can see I don't always get this perfect, which is fine. But we posted this idea already on the daily time frame. We outlined the support, we outlined the resistance, we outlined the targets. At the time of the post, it was like 1,347 ticks, so that's what you're gonna see. You get a little bit of a description, which is great, and then you hit this play button to where whatever happens, you can see if I'm right or if I'm wrong. All right, everyone, this concludes this week's idea. I want to say thank you so much for the opportunity to work with you. There is risk involved in trading. You should never invest money you cannot afford to lose. Always keep risk management in mind. Understand that we are not CTAs, which stands for Commodity Trading Advisors. What that means, what I'm sharing with you is research. What you do with this information is completely up to you. Past performance not indicative of future returns. What that means is there are no guarantees of a positive outcome. Every single trade involves risk. You should be very aware of that. Look at us like a newspaper. We'll share with you this research, but what you do with this information is completely up to you. All right, everyone, that concludes this week's idea. We'll see you next time.